This is Jim Barlow of OakTree Premium Finance, presenting my traditional transforming life insurance into a powerful wealth building tool. I'm happy to see the continue attendance by people listening and watching from all over the country. Added a few things, changed a few things up to try to make it a little clearer, cleaner. And anyway, let's get started. So for centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. Well, I'm the alchemist of leverage. I'm going to show you how you can turn life insurance to a wealth building tool. By the end, I'm going to show you some tools that you can use to study the details, and I'll let you welcome you into the new alchemy of wealth creation. My wife is Barbara Barlow. We've been blessed with 7 children, 28 grandchildren. I graduated from BYU. I remain a devoted fan. I worked as an investment advisor for 35 years. Our passions and values: we love to travel. We visit family. Last week, we were in New York with a granddaughter, and we went to 8 plays on Broadway. We enjoy family vacations. We read. As I said, we had 10 plays. We treasure time with family. We serve in the temple, and we strive to be disciples of Jesus Christ. Above all, I believe in doing good and helping others. Let me tell you a story about an alchemist in the 1700s, Johann Friedrich Budga. I try to put down the kind of the English pronunciation there, for at least for me. Anyway, he was a young alchemist. He was an apprentice, and one day he did this experiment with the chemicals and everything in front of his mentor, his boss per se, and a friend of his, and he was successful in kind of fooling him, showing how he had turned lead into gold. And it went abroad, and Augusta the Strong, the ruler of Saxony, he imprisoned him at age 19. He wanted to fund his empire with alchemy. And so under pressure for 7 years, he experimented, refining heat, blending minerals, testing clays, driven by belief that something here could be turned into gold. This is from a book that I love to read. I've read it a couple times. The Arcanum, the extraordinary true story of the invention of European porcelain. That's kind of a hint to where we're going. In 1708, along with scientist Arenfried von Kirschhaus, Budger discovered how to make hard paste porcelain, a secret only the Chinese possessed. This was turning clay into something valuable, and the Meissen porcelain manufacturing company was formed, and European porcelain started. He didn't live very long, died at age 37, but back then, I guess that's maybe a long age. Anyway, by experimenting, he did find something very valuable. You know, we're really living in a world of alchemies taking place. I'm continually surprised of all the cool things I have that I didn't have as a kid. My smartphone, wow. The internet, social media, online banking, retail, Amazon, ChatGPT. There's things in healthcare. There's online learning. There's Elon Musk has built SpaceX, planning to go to Mars, renewable energy. There's a lot of things. And what it all is people are looking for a better way to do something. That's all these things are, a better way. Alchemy is nothing but finding a better way. So, transforming life insurance into a powerful wealth building tool. We're going to blend life insurance, a growth strategy, and leverage into a powerful alchemized approach for exponential wealth building. I'll show you how to explain how it works. A company out of Texas, NIW, they're the ones that kind of did the alchemy, original alchemy, experimented and looked at things, and they gave this alchemy a name. They call it Kaizen. And their buzz line is more money, more protection, more confidence. Kaizen is a Japanese term meaning continuous improvement. And they continually looking for ways to tweak this and make it better all the time. The uses of Kaizen are basically three big, broad areas. One is personal and family use. That's the number one. Number two is business uses, and then advanced high net worth uses. Let me show you the details. So the personal and family use is kind of the core. This is where most sales are, protecting families while creating more freedom and income for the future. The number one reason people are buying it is create more retirement income. And kind of a subcategory to that one is it grows tax advantage. You're growing tax advantage assets with no RMD, required minimum distribution. Minor detail, I guess. But they're also buying it for protection for family security and also for the living benefits, the disability and long-term care. That's the number 1, 2, and 3 of why people are buying Kaizen. Another reason that I didn't give it a number, but safeguard assets through a trust-owned creditor protection program. And the last of this personal and family use is transferring meaningful wealth to family. This is the core. This is the main reason people use Kaizen. The business uses, this is where they're trying to protect their business. They're trying to grow their business. The number 5 reason people buy Kaizen is to attract or retain top talent with executive benefits. They do a one-on-one contract with an employee. They don't have to do this with all employees and give them a special perk. Also, a business use provides succession and continuous liquidity while protecting ownership with a funded buy-sell agreement. So this is when partners pass away and you need to buy out their family. A big use of Kaizen. And last, safeguard vital executives. People do Kaizen on an executive and then keep ownership, the company, so that they have funds to replace him if he was to leave. That's the business uses. Then I call the third category advanced or high net worth use. Number one, there is shield estate from estate taxes. Estate taxes, how much you can pass on without estate taxes, a large number right now. 14 million for an individual, 28 for a couple. You can see this is for people are using, high net worth people use it for this reason. They also use it to equalize inheritance. So maybe Junior's getting the business, so they do this to equalize to the other heirs. Multiple legacy and creditor protection through dynasty trusts and insurance life insurance trust, ILITs, and also to support charities, give funds to uh, Weaver State, or wherever. Anyway, these are the three broad areas of use of the Kaizen. Whether your priorities are protecting family, strengthening your business, or preserving lasting legacy, Kaizen adapts to your needs. One strategy, many applications, all designed to give you more security, more income, and more impact in your life. I created another list. This is a list I've been using for a few months. The previous slides were all new. This strategy provides more retirement income with less out-of-pocket costs, provides tax-free retirement income, has no downside market risk. It has protection, and it has the living benefits, long-term care, disability, minimal financial disruption, only 5-year funding, simple, low maintenance design. You don't need to be watching the market every day. Creditor protection, strategic giving to family during life or at death. Executive benefit we've talked about, succession planning, a legacy planning tool. And my mission is to educate, challenge conventional thinking, and empower you to use this strategy to its fullest. So here's some guidelines. The age range is from 18 to 65. By Kaizen, it's life insurance, so you must qualify standard or better health. You need to have a certain financial strength. Obviously, just to make the payments, you have to have a certain financial strength. And we want people to stay with it. We're planning a 15-year structure minimum before you're tapping it. You could also call that a disadvantage. It's not a quick fix. It's not buying Apple the day before it skyrockets. So let's show you the bullet points on the three. First, life insurance. Here's the 4 bullet points. You have a death benefit. It's life insurance. 2, you have living benefits. These came about in 1980 on, where you can tap part of the death benefit for terminal illness, chronic illness, critical illness, long-term care, heart attack, injuries in an accident. I think this is a really solid reason for people to have Kaizen. The 3rd bullet point is the tax advantage one. The Revenue Act of 1913 is the act that brought about income taxes. And right in the wording of that bill is they made life insurance beneficiary get the money tax-free. It's been that way since the beginning of the income tax. I don't think they'll ever change it, but who knows? So while the money's in your account, it's growing tax deferred, not paying taxes as it grows, and you can tap it without dying by doing policy loans. This is how we give you a tax-free retirement. This is a big point for me. We'll show you more details. Also, there's no investment advisory fee. I charge 1% in my career. There's no management fee built in. So you've got some fees that are just minimal that are prevalent always in the investment world. That's the 4 bullet points. I'm going to do this throughout the presentation. I'm going to do a summary page. And there's the 3 areas we're going to be covering. So legacy and living benefits, that's the protection, strengthens financial security. Tax-free growth minimizes tax exposure. No management fees, eliminates hidden costs. We'll add the others as we get to them. So, above all, I want to stress this. You're protecting your family. You're protecting it and having long-term care benefits for yourself. You're protecting your income if a disability strikes, whether it's injury or illness. It's making sure you and your loved ones are financially secure when life takes an unexpected turn. I never want one of my clients to end up relying on a GoFundMe account. I want them to have peace of mind that these potential things that could happen, you're covered in case it happens. That is real security. We're going to use a hypothetical case. We're going to use a male, 45, excellent health, non-smoker, annual income 240. He already has 500,000 set aside. He's willing to put in 50,000 a year for 5 years, and he'd like to have distribution income starting at age 65. Looks reasonable. The NAIC, National Association of Insurance Commissioners, regulates the insurance industry through this association, and they're always they say what illustration rate is allowed. And on July 3rd, I updated my numbers here, and it was 6.45. I believe it's still the same. Good. That's the return we're going to use. We're going to use a 37% income tax bracket. We're going to use long-term capital gain rate of 20, and a state income tax rate, which is an average of all states, 5.5. Interestingly, the average Kaizen sale throughout the country is a person age 46, and the average annual payment they're making is 70,000 a year, not 50,000. So I use this as kind of the a round number around everything, but this is kind of about what's the average person is using Kaizen and putting into it. So we're going to use this as our hypothetical, and here's our first crunching of numbers. And here's the columns we're going to follow. If you put 50,000 away for 5 years into an after-tax account, and you got that 6.45% return, and then you kept it a year and a day, and paid the 20% capital gain rate and 5.5, you'd be able to pull out $37,699 at age 65, and at age 95, you'd have pulled out $1,168,659. And the way I'm doing this is I'm using every penny. I'm still having it grow while you're in retirement, but I'm pulling out every penny so it's totally depleted at age 95. Then I did it with tax deferral. If you did it on IRA or 401k, and this is where you got 47,842. That's alchemy. That's more, 10,000 more than investing. So the government has provided us a way to do a little alchemy through them. And the total income will be $1,483,000. And we'll show you how Kaizen stacks against this in a bit. So we've covered life insurance. Now let's talk the growth strategy. Life insurance, term insurance started in 1761, whole life insurance 1842. And in 1997, not that long ago, a concept was built called Indexed Universal Life, combining growth potential with protection. And this is what we use. And here's the reasons why. Growth with protection, cash value growth in the insurer's account with index options providing potential gains without downside market risk. In a year where the market's negative 20, negative 10, whatever, you can't have a negative return in this product. You get a zero in a negative year. And we'll show you how that is done. And you have your investment options are index options, and you can go with capped funds, and you can go with participation rate funds. Capped is like if with the SP 500, you get that return with a protection at zero. You can't lose any money, but it might be capped at 12.5, meaning if the market does more than that, you're capped. A participation rate method is you get a percentage of the return. And right in this economy, the percentage is right around 200% plus. So if the index is doing 5, you're getting 10. If your index is doing 10, you're getting 20. No cap on the participation rate. And they're usually higher than 100%. That's the two major investment options you have. And then I want to mention it's very turnkey because minimal management, you can only make changes to your investment once a year on the anniversary date. So you put it in the account and forget it, knowing that you have a zero in negative years. This is the growth strategy we use. Here's how they do that now: zero return, zero, no negative years. So $1,000 beyond the cost of insurance, they put a certain amount in their general fund, the insurance company's general fund, and then in 5% interest market, that'd be $952. And they know that 952 will grow back to 1,000 in 1 year, protecting the principal. And then they have a certain amount of money, $48 in this example, to go out and buy some options. And that's how they get that capped return or the participation return, by buying different indexes with the investment world. If we're in a higher interest rate market, like 15%, then they would have more money for the option budget to buy more upside and still protected that you can't lose money from year to year. Hope that's clear. This is the important part. So now we have the growth strategy. No downside, market-like returns. Pretty nice. So now we've covered life insurance and growth. Now we'll go to leverage. Let me talk about mortgages for a minute. Kind of this is the advertisement or break time, I guess. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. I never knew that. I was alive then. You weren't alive then. But in 1934, the FHA was created, and creating the 30-year loan, which revolutionized home buying. Before 1934, 40% were able to buy a home. Today, 66%, 50% increase, more than 50%. 85 million residential mortgages are currently outstanding, 12.6 trillion. People are able to buy homes that could not before 1934. So why do I talk about this? This is because you're borrowing money. This is leverage. So here's how we use leverage in our society. We buy it for home ownership, that mortgage I've been telling you about. People buy it for buying real estate. They put a certain amount down, make payments. They do it for businesses. They borrow money to keep the business afloat and whatever. They do it for investments through margins accounts with your advisor. People use it to student loans, education. Those are four great reasons to use leverage. There are reasons that are not so good. Transportation, if you borrow money for a car, you're borrowing money, paying for a car that's slowly deteriorating. It's not going to grow in value. It's very few that are collector items. We borrow to pay for healthcare costs. We buy for everyday essentials. We have credit cards that makes life so easy, but maybe we don't go ahead and think that it's going to cost us 24% interest. But we do use leverage for everyday uses and for major life events. Be best if people didn't use them for those bottom four. Use leverage for the right, good leverage, not for the bad. Here's a picture of Barbara and I in Cabo. I was going to put a date on that. I'll look it up. A date of Cabo, brightening note. I should do some more pictures. I didn't take many pictures in New York last week. I probably should have. Anyway, so my question is, why are we not using leverage for retirement? Oh, can you? How do you do that? Well, that's what I do. So how do we use leverage? We should add into this good part, retirement planning, asset leverage. So here's the leverage part, the banking. Leverage maximum in real premium finance is 20 to 1, but we do borrowing 3 to 1, conservative leverage. And we do this without having any guarantees on your part or collateral. And we do it for 5-year payments, 5 annual payments or 60 monthly payments. You're not going to have to pay this for the next 20 years, 30 years, or life. We've got a short time. We want to get money into this account to grow quickly. And we've experimented with different time slots, and it works best at this 5 years. We have a trust ownership, a living trust. We have a master trust provided by Provident Trust. They're the ones who are doing the bank borrowing. You don't have to do your own borrowing. And they're doing the management of that. And there's a bunch of other things that if I went through these things, would be here another hour. But they tweaked a number of things in the normal policy to get this thing to work the way they want. Here's a visual. You have 5 payments, 5 annual payments. That's the silver pigs. And approximately, the bank is going to put in 5 payments in that first 5 years. They'll be approximately the same amount. After 5 years, you're done. You don't put any more money in. But they continue making their payment they were for 5 years, plus they assume what you're putting in. And that kind of shows you that visual about 3 to 1. If you're putting in 100,000, 20,000 per year for 5 years, then over 10 years, they're going to be putting in 300,000. A simple strategy and not major leverage. And all without the typical risks of borrowing. No credit checks, no loan documents, no personal guarantees, no signature, no collateral. The bank, the way we've done our loans is they accept the policy as a total collateral. No more, you don't have to pledge your children or anything or sign documents on the loan. The bank is doing all that, sign loan, and you're not obligated to it. This is a part that was really important that this got done. So how has this thing performed? The very first policy was in 2012 to one of the owners. And once a year, they come out with a statement. And I should have checked. Let me take it in the note. Check to see if 2025 statement has come out. I'm using the 2024. Last time I looked, they hadn't updated and showing it 2025. But this first policy has averaged a return of 7.73 from day one through June 26, 2024. They've also averaged a borrowing rate of 3.81. So on their portion that they put in, they're making they made 7.73, but on that borrowing, that 300,000 to 100,000, this person's been making 3.92% on the borrow money. We call that the spread. So I want to borrow more and more money if I can make 3.92 on borrowing money. Wow, interesting. And we did a back testing study. We back tested this to 1930, a long time ago. There's never been a 15-year period of time with a less than a 2% spread. Now there are individual years. The market's a negative, you get 0, which is less than 2. But and maybe you can have 2 zeros in a row. You can have high numbers in a row. Anyway, by that back testing, there's never been a 15-year period of time that you've averaged less than 2. So in my mind, I'm going to get 2% from borrowing money, and maybe 3.92. Maybe you'll go even higher than that. But 2 to 4, not bad on borrowed money. That's the alchemy. We're creating money out of borrowed money. Here's a diagram of the trust. So we have this master trust at the top. They're doing all the daily things and they're dealing with the banks. And then we have you, who have also we set up a trust for you because they can hold trust assets in the master trust. And you put money in during the year, you take money out, like we've been talking about the stock. And it's protected because it's out of Nevada and it's working well, the trust strategy. So these are the numbers we showed you a few slides ago. And I did a drum roll, please. I'm going to show you what Kaizen would give per year, or 65. Who would bet that it's 57,000, another 10,000? Maybe it's 67,000. Maybe it's 77,000. Maybe it's, am I going crazy? Here we go. Let's do the drum roll curtain, please. And it is about 90,000. About 42,000, more than 47, almost a double from the tax deferred, almost, but is certainly a double for the after tax. And there's how much income this strategy would pay out through 95, but it's not done. There's initial death benefit when you bought it, and there's a death benefit at 95. The illustration program showed 90. So I had to go with what the illustration said. But anyway, you haven't spent it all. You're getting a 90,000 income tax-free per year. That looks pretty nice. This is the crunching the numbers part. Now, got two different scenarios I want to talk about. One is the Great Depression, one is the high interest rates of the 1980s. The Great Depression was horrendously bad. notice the middle part, from 1930 to 1932, the stock market lost 70% of its value, and it did not recoup or recover until 1959. It basically had zero return for 30 for 30 years roughly. Wow. Well, we did a stress test, and in our stress test to stress for a Great Depression, we did 9 out of 10 years at 0. Notice we don't have a negative, and I'll show you the performance of this stress tested. But we also did a stress test of the 1980s, where interest rates were really high, the highest in any given decade ever, and for the United States, that is. And rates became as high as 16.88. So here's our stress test numbers. For the 1980s, 67,000. For the Great Depression, 58. Well, remember when we had the tax deferred at 47, and I said, wonder if it would be 57. Well, with even a Great Depression, it did 10,000 more. Wow. And even in 20,000 more close for the 1980s. This works even in bad times. Now I had to do something more. Let me tell you what's going on here. Allianz is one of the life insurance companies that we use for Kaizen, and they did a study. They looked over NIW's calculations on these illustrations, and they wanted to see if they're accurate. And they came back and said there's an 80% chance that this number will be a double. Instead of 90,000, there's an 80% chance it'll be 180. Wow. And the income from that to 95 is 5 million. 180 compared to 37,000 or 47,000. Wow. Amazing. So you're probably pretty safe to think 90,000, but 180,000. Wow. So now we can flesh out this last group. We have leverage, 3-to-1 leverage, capital gain outlay risk. We don't have to put as much money in. 5-year funding, trust ownership protection, trust structure, turnkey design, very simple, liquidity and flexibility. During the first 15 years, no. But after that, total flexibility. So these are the bullet points, the key features of Kaizen. There's something, a famous 7-point risk matrix. I thought I'd have a little fun here. In the 7-point risk matrix, the lowest is FDIC insured savings. Yeah, that makes sense. FDIC insured savings. Number 2 is government bonds. At the other end of the spectrum, extreme risk, we got cryptocurrency, options trading, startups. 6 is private equity, speculative real estate. Or as Kaizen said, we left off 3, 4, and 5. Is it going to be in that 3? Really? Is it not that much more risk? There it is. The moderate to low risk, 3, is high quality corporate bonds, annuities, and Kaizen. Then a balanced mutual fund is in the middle, 4, and then a stock heavy portfolio, premium finance, for the 5. So you can see you can do this with low risk, no downside. We have a couple cool tools This is the first one. This is a landing page. And you don't have to have a login or a password to go to it. You just go to it and study Kaizen to your heart's content. There's the QR code that will take you to this. There's videos. There's chapters on leverage and everything. And you go to that website and learn about Kaizen. Uh, there's a lot of information on this landing page website, and you can study it out. And if you have any questions, you can just give me a call. Happy to help. They also have a second one, landing page, and they recently redid this. This is for if you're giving your assets to a child. And I haven't created a QR code for this yet, but I have the link. If you want to study this out on how you could give money to a child, it's the same thing, but if it's $50,000 a year, the policy is owned by the child, and you're paying the payment, and you're building up this asset in the child's name, and you're told the 15 years, and they're letting it grow, and you're just making the funding. So if you're interested in this, send me an email, call me. I'll send you the link so you can study Kaizen from this point of view. My website, I think, is terrific. My web designer is very professional, has a lot of interesting things on it. I've got a bunch of links you can go to things and learn about. I've got some retirement calculators I built. A lot of things there. Here's the retirement income gap calculator that I built. It's really simple to operate. You can do it just and ballpark things just now. You put your current age in the left, you put a age you want to retire, you put in what you think the inflation rate will be, what your current annual income is, and the average person will spend 80% of their current annual income in retirement. You can go with the 80, or you can make it 90 or 100 or 70. You put in what you've accumulated, and you put the rate of return you're going to anticipate getting on your investments, and what age you wanted this. Oops, I'm sorry. I went ahead too far. Let me back up. Sorry. You put the age at which you want to have this income last. So in this example, the desired annual income at 65 is 285, with inflation from 240 to 285, and the money they put aside will grow to $1,934,000, and that will provide $129,000 using every penny of it through 95 income. So 285 subtract the 129 means you have a gap. You have 155,000 gap per year, and I like to help people solve this gap. I have an advanced calculator, more detailed, talks about Social Security and what you have in a Roth IRA, Roth 401ks. But it will give you a more fine-tuned answer, and here you get your exact numbers out and put them in. Not hard to work either. It's very simple. And that's it for today. Let me go to my panel thing and see if I have any questions that people have asked during the time. Questions, there we go. I'm really pleased. I don't have any questions, but maybe if you're reluctant to type them out or even call them in, that's fine. Give me a call, send me an email, send me a text. Be happy to help anyone anytime with anything with the Kaizen. And you can tell your friends about, I try to do this once a week, and you'll see a post them on my LinkedIn account. Now there's the QR code again to start the so you can go to that landing page. Let me leave that up in a bigger form for a minute. All right, there's the bigger form. But I appreciate everyone attending today. 11:46. A little too wordy today. I'd really like to get this down to a half hour. Well, have a good afternoon, and we'll talk to you again. Have a great day. Bye.